Professor Diaz here, and in this video I'm going to talk about debits and credits and the accounting equation. And this is just kind of an introduction and overview, some of my thoughts as we get into chapter 2. Debits and credits are the foundation of everything accounting. This is such an important concept. This may be the most important chapter of the entire book, right? The biggest thing you need to remember is that debit simply means left. Okay, that's all it means. And credit simply means right. Now, this is a huge hang-up for most students as they get into this course. They think about debit cards or credit cards or crediting a bank account, and they try and make correlations and like, oh, now that makes sense. And I'll tell you right now, don't do any of that because it will all make sense eventually, but it's not like you're thinking. It's not at all like what you're thinking, okay? Debit means left and credit means right, okay? When we're talking about accounting, we have the accounting equation, right? And so I'm going to put the accounting equation here. You should be pretty well exposed to this by now. Assets equals liabilities plus equity or owner's equity, okay? The whole purpose or the whole point of accounting is that we can keep everything in balance with this equation, right? Just a recap, a reminder, your assets are everything in the business that has value, economic worth, such as buildings, cash, accounts receivable, that's where people owe you money, prepaid expenses, because you've prepaid them, they owe you a service, right? These are all examples of assets. Liabilities are somebody else's claim against, somebody else's claim against those assets. So if you have, let's just say a very simple business and all you have in that business is one building, right? You would have that as an asset. Now, if you have a mortgage against that, then the bank has a claim against that building, right? So if the building was purchased for $200,000 and you have a $150,000 mortgage on that building, then the equity that you have is going to be $50,000, right? And this could be said as this is your claim on that building, right? The owner's claim. So the equity is the owner's claim, the liabilities are other people's claims, the assets are the economic value inside the business. Now, liabilities are really any debts or anything that anybody owes, because even if we talk about some sort of little debt, like say accounts payable, right? Accounts payable, this is just say owing somebody. Now, technically when you owe somebody, they have a claim against your assets, right? And so that's what liabilities are effectively. Now, when we're talking about debits and credits, we could draw that imaginary line right here down the middle of the equal sign, okay? Everything on the left over here in the asset section, it goes up with a debit and down with a credit, okay? Liabilities are on the other side of the accounting equation, and so liabilities go up with a credit and down with a debit. This is why you need to stop thinking that credit means increase or decrease, or debit means increase or decrease. It doesn't, right? This is the debit side. This is the credit side. This is the debit side. This is the credit side. Left debit, left debit, right credit, right credit. So you can see for assets, a debit does mean increase, right? But for liabilities, a credit means increase. And so these in and of themselves don't mean plus or minus. For assets, debits mean plus. For liabilities, debits mean minus. And I'll just give you a simple example why that is right now. If we're doing a journal entry and we say we get a loan, right? We get a loan. So we know that we're increasing our assets and we're increasing our liabilities. Let's say it's a $100,000 loan. So $100,000 loan, $100,000 loan. How would we journalize that? We would journalize that by doing a debit, because plus, we want to debit assets. So we would do a debit to cash, and we'll just write cash like this. And we would do that for $100,000. And then we would do a credit, because this is going up and up with the credit, to loan or mortgage or whatever we said for $100,000. And we always, when we're doing journal entries, put the debits, by the way, DR is short for debit and CR is short for credit. We always put the debits kind of indented over here, and the credits like this, the debits and the credits, right? And so we can do multiple journal entries this way. We would do another, debit, another credit, write the number, another debit, another credit, write the number. We could do multiple journal entries this way, always having a kind of distinct debit column and a kind of distinct credit column. So look what's happening in this example journal entry. We have cash that we debited, so cash went up for 100,000, and we have loan that we credited, which also went up, right? Neither account is going down, right? Neither account is going down. Both accounts are going up. The business has more asset, but the business also has more liability, this loan, right? Because all of this cash, none of it was earned through equity, right? None of it was earned through revenue. None of it was contributed by the owner. It was all come in through this debt, right? So even though the business has more cash, they also have more debt, right? So this is just a very basic example of a journal entry where we have plus debit plus credit, right? So let's talk about equity. Equity is definitely a little bit more tricky when we're talking about the accounting equation. As we look here, let's put those back actually for a minute, all right? So we've got this plus and minus, and then liability is the opposite. So we've got minus and plus. Now for equity, it's on the same side of the equation as liabilities, okay? So this is how I like to think of it in my head. I would just say equity goes up with a credit, down with a debit, right? The problem with that is it's a little bit too simplistic, but I like simple, right? I like simple. So what we've got here is assets up with a debit, liabilities, and equity up with a credit, okay? The problem is equity has multiple types of accounts, right? And so as we look at equity, let's go ahead and use red here. There's really 4 types of accounts inside of equity. You've got your revenue, you've got your expenses, you've got your contributions, and you've got your draws. Okay? So, and now we should have each of these things kind of have their own little deal of what makes it go up or down, right? So for revenue, when revenue goes up, equity goes up, right? So this is, again, how I like to think of it. Equity goes up with a credit, and revenue is making equity go up. Therefore, equity goes up with a credit and down with a debit. Expenses, when an expense goes up, think about this. When an expense goes up, that means your equity is going down, right? So this one's going to be the opposite of this. It's also going to be the opposite of this, right? So when we're talking about expenses, expenses go up with a debit and down with a credit, okay? Contributions, when you contribute, that's the same as equity, right? Same as revenue. And so that's going to be up with a credit, down with a debit. Draws is going to be like an expense. When a draw goes up, when a draw increases, your equity is actually going down, right? As an expense goes up, as a draw goes up, your equity is decreasing. So it's going to be opposite of the equity, right? So with a draw, that goes up with the debit, down with the credit. Okay, so now we've got the basic framework for all of the ups and downs, right? The increases and decreases. We also call these normal balances, okay? So we would say the normal balance of an asset, the normal balance just means the side it goes up on. So the normal balance of an asset is debit. The normal balance of contribution is credit. The normal balance of revenue is credit. The normal balance of liability is credit. See, whatever side makes the account go up is the normal balance. Now, this is a lot to wrap your head around. It will take you most of this quarter and some of you into next quarter to fully kind of get this down. And in the meantime, there's this, AED LRC. And I've seen a lot of students write this on the top of their exam. They memorize it. They walk into the class saying AED LRC, AED LRC, AED LRC. They write that on the top of their exam, and then this reminds them AED, assets, expenses, and draws all go up with debits. LRC, liabilities, revenues, and contributions, or capital, you could look at it that either way, all go up with credits. Oops. So AED LRC is a quick shorthand to help you remember, but really you're going for understanding this concept, why this happens. Eventually, you know, I never think about AED LRC anymore because I just understand how it works, right? And that's what you're trying to do as well. You're not trying to memorize what these are. You're trying to understand how they fit together, right? And once you understand how they fit together, you don't need any, you know, mnemonic or anything to remember it because you actually understand it. But in the meantime, this does not hurt at all. I've seen a lot of students use that for success. Okay, in my next video, I'm going to do an example and I'm going to do some journal entries and try to flesh this out even more.